Manish, good morning. Thank you for joining us. One side is this entire rotation which is on in the market, which is people are buying into cyclicals, industrials. On the other side, Zomato and Paytm are planning to go public. What are markets telling you? Which is the right side to look at it? The one which is dominated by startup space, where earnings are not there, cash flows are not there, but excitement is there? Or should one look at the other side, where companies which are at the cusp of earnings, operating leverage and cash flow cycle?
Nikunj, the new age internet companies will have a place in Indian markets. Starting this month, you have a flurry of IPOs coming over the next 6 months. Traditionally, Indian markets have really not given too much of value for companies which do not generate profits. But I think new ways of valuation needs to be learned other than the traditional ways of valuation. And definitely some of these businesses are very scalable going into the long term. They create value for customers. So something like a Zomato creates immense value for customers. Today, the takeout rates or let's say the delivery charges make it a profitable model. How much scalable it is going to be in the long term will determine how much of excitement some of these names will generate going into the future. Valuations are pricey if you look at the long term, but I think traditional ways of valuation have to be done away with when you look at valuing these companies. So I think it will be a mix of both the traditional businesses that we have been used to looking at, plus the new age internet companies will also find a place in portfolios going forward.
When we spoke last, Manish, you said you're buying into industrials and cyclicals and you were betting on the economic recovery and revival of the capex cycle. Has that theme got only endorsed looking at the way of steel prices, copper prices, sugar prices, and the demand for cement has gone strong?
See, we have really not seen the capex cycle, come back post the global financial crisis in any meaningful way. Now with the government impetus, thanks to the pandemic, is there on capital formation globally. Governments and central banks are pumping liquidity into the system. Governments have picked up the ante, spending a lot of money on infrastructure, and private capex is going to follow. I think the true picture on the numbers will come to light only after a gap of let's say 12 to 18 months. So I think it makes sense to buy ahead of the cycle playing out because here you get the valuations very benign, looking at the next upcycle. Some of the valuations like steel, etc., have moved up. There's a lot of room for an upside in these names. And also on the industrials, private capex, infra names, these would be new sectors to look in, preparing oneself for the next upcycle in capital formation. I truly believe that capital formation will be the order of the day going into the next 2, 3, 4 years. Rotation trade will play out. Consumer stocks, particularly staples, which have had their place in the sun post the global financial crisis, with or without numbers or earnings, are trading at very elevated valuations. These will be taken off in terms of profits from portfolios, and this capital will move into either new age internet companies or some of these industrials which are languishing, so to speak, over the last many years.
Manish, Tata Motors yesterday surprised everyone, shocked everyone, and they certainly have set cat amongst the pigeon when they said, look, there is a semiconductor shortage in the world and we will have negative EBITDA or we will have negative operating profit margins. What does this shortage of semiconductor mean for Tata Motors and other auto stocks? Because if Tata Motor has a semiconductor or a chip shortage, other companies will also have the same.
Yeah, just before coming to that point, I mean, this also brings on the table how fragile or the market conditions are. Yesterday we saw 10 bips increase in government yields, government bond yields, the 10-year, and some negative news coming out of Tata Motors, and the markets gave away all the gains. So markets are really, even as the juggernaut rolls on the market, markets are really looking for some negative news to correct. So that's one portion. Now, coming specifically to Tata Motors, not just Tata Motors, I think globally there has been a chip shortage due to the large corporation in Taiwan which manufactures globally, on a global scale, the chip that is required for many industries, whether it be air conditioners, whether it be motorcycles or two-wheelers or four-wheelers. I mean, that's the order of the day. And, auto majors have been highlighting that there has been a chip shortage over the last, two conference calls. There was some hope that this is going to get abated over a period of time. It has not really got through, even as we speak in this quarter. So I think everything else being in place, the demand being in place. If you don't have a semiconductor that is to be put in the automobile, the vehicle doesn't come to the market. Of course, it's more of a supply side issue than a demand side issue, and markets are actually going to look through this. As far as the negative cash flows, I mean, they have been writing off a lot of assets over the last many quarters. I mean, this is, what it highlights is the amount of capex that they had done in Tata Motors, particularly JLR. The amortized value has to be taken into account because, the assets are actually being carried at more than the fair value that it represents. And it only demonstrates some poor capital allocation on account of for the company in the preceding years, and that is now being brought to market. The mark to market is being taken. So this has been the problem for Tata Motors for quite some time, even as the outlook on the domestic CV business is pretty decent. But this constant, continuous asset write-down seems to disappoint shareholders quite massively. So that has been a problem. I think chip shortage will get abated maybe over the next 6 months if global majors like Bosch, etc., that is what their opinion is. It has been continuing for the last 6 months. It may continue for the next 6 months as well. But the demand, the pent-up demand in the system will remain. You can postpone these sort of demand because of supply side issues, but the demand perfectly stands intact.
Hi there, good morning. Wanted to also understand how you're looking to play the entire agri theme. For now, monsoon seems to be have paused a tad, but with the predictions of a normal monsoon, is there any way that you're looking to bet on rural as well as agri stocks?
Yeah, I mean, look, agro-chemicals are in a sweet spot. Only problem is fourth quarter of FY20. A lot of shipments got delayed, and not shipments, the supplies got pushed to the first quarter of calendar 21. That is April, May, June 20, the first year of financial year 21. So from that point of view, I think, on a YY basis, the first quarter numbers are going to look like single-digit earnings growth because, a lot of postponement of supplies happened to the first quarter of FY22 vis-a-vis what was supposed to happen in the fourth quarter of FY21. This was due to a lockdown situation that we entered, the first lockdown that we saw in the fourth quarter. But on an ongoing basis, I think the second, third, and fourth quarter will work very well for agrochemical companies particularly, and the fertilizer companies in general. And valuations are pretty, benign compared to historical valuations when we had good monsoon. I think this is one space which looks good. The wealth effect in rural India is clearly there because of rising agro-commodity prices globally, and the fact that we have had decent monsoons last year and even this year. MSPs have got increased, so that contributes to the wealth effect. So I think apart from the second wave of the pandemic, which has hit rural India pretty hard, and rural India will take some time to come back when we compare it to, let's say, urban India, which will come back faster. There are some spaces like your agrochemicals and fertilizers, which look like to be in a sweet spot and will look at re-rating on valuations going into the second, third, and the fourth quarter.
Fair enough. Expectations are rife that this time around for the earnings. We could see a strong demand environment, strong deal momentum continuing when it comes to IT, and some of the frontliners like Wipro could lead the overall growth. TCS, Infosys as well could see industry-leading growth within the large caps. What are you betting on when it comes to the IT space and the earnings, which incidentally begins tomorrow?
So the IT story is here to stay for at least the next couple of years. I mean, that's a given. The demand environment is extremely strong. But there are supply side issues as well. So the key thing to watch out for is how much of traction and deal wins do each of these individual companies have. And at the same time, what is the margin picture going to look like? I think the clear monitorable as far as IT companies is concerned, and there's a disconnect between guys who are bullish or bearish, is not in the demand aspect, which is going to be quite strong, but how are they going to, traverse through the margin picture? Because a lot of expenses which were hitherto not there in the last year has come back. Travel expenses, sales, marketing, general expenses, they will tend to move up. Salaries have got increased. There is a shortage on lateral hiring as far as talent pool is concerned. So how each of these companies manage the employee pyramid is going to be something which would be watched out for in the numbers. But the environment remains quite strong. The sector is in a sweet spot. I think commentaries around longevity of growth on the IT sector beyond 2023, that is the next 8 quarters, that is going to be what is going to be watched out for, and how the margin picture looks like in each of these line items, cost line items, which each of these companies work through.
Manish, let's say if I look at your portfolio 3 years ago, it was dominated by HDFC Life, HDFC Bank, Eicher Motors. I could throw in something like a Page Industries. What are the dominant names in your portfolio where you think that next 2, 3, 4 years, 5 years, what happens to stock is not something we can control, but we can certainly get a sense of where earnings are headed?
I think if you look at the current situation, I think IT, pharmaceuticals, financials, and to some extent consumer. These would be the 4 dominant themes in our portfolios. And within that financials, it would be more a case of banks vis-a-vis NBFCs. Thanks to the valuation difference, NBFCs are really trading at some elevated valuations compared to the preceding years. IT and pharma are clearly in a sweet spot. We are through mid-cycle valuation numbers, demand traction and growth looks pretty good. There'll also be some place, maybe not overweight position, but there will be some place for even industrials and capex recovery plays, infrastructure. These will also find some place in the portfolio. I think the construct of the portfolio would be broadly on these lines going into the future, next 2-3 years.
Within the index, when I say Nifty 50, which are the two, three names you think are likely to surprise us?
Metals is clearly one space. It has really gone up 2-3x from these levels, and I think the environment for metals is pretty strong. And now that they have some decent allocation in the index, this will be one space will be watched out for. Of course, the ESG angle comes through, because these are polluting industries. So, companies in the commodity space, and specifically so in the chemicals or in the metal space, which has a good ESG score, they can really surprise on the upside. Plus, we'll have some of these large unicorns, the new age internet companies, they will be starting at $1 billion plus. And of course, some of these will be multi-billion dollars in terms of valuation. These will definitely come into the index at some point in time. These have a propensity to surprise us on the upside or on the downside, given how scalability on some of these businesses are going to play out, as far as the visibility into the future is concerned. So analysis on the scalability in terms of growth in top line and the margin picture, because that will basically determine the valuation. These companies are really not making profits at the net profit level. So I think these are 2 spaces which will clearly surprise. I think LIC, when it comes into the index, will be a no-show, given what they have in their books, etc., and the fact that there is value migration happening from public insurers to private insurers. So I think these would be the two spaces which should be clearly on the watch list. There could be a lot of alpha or negative alpha which can come or not come because of these two factors.
Bharat Forge is up looking 3%. You got TVS Motors that's making a comeback. Tata Motors is also looking very decent. You got uptick which is now clearly visible in some of the energy stocks as well. Manish, for next couple of months, where is energy as a complex headed? Oil prices are high. Markets are no longer using crude as a dirty word. The ESG framework which people have used suddenly is not applying because NTPC and ONGC and HPCL and BPCL are doing well. Is there merit in buying energy stocks?
Definitely there is merit in buying energy stocks. So we could see crude oil move up to $80 and beyond. That's clearly on the table. There are some experts who are even talking of $100. The refining piece is in for a super cycle as like metals. Because what is happening is that there is a global open up trade which will bring demand of something like 5 million barrels. Right there, you don't have too much of supply coming in because of this whole EV angle. Not too much of supply is coming in. Some bits and pieces are coming through. Shale gas is not going to change supply dynamics significantly. So once you have, let's say, demand come through because of this whole pandemic open up, and then you don't have supply, getting augmented either through OPEC or otherwise, you are looking at a situation where product demand is going to be far in excess of what it has been. So currently, let's say Singapore GRMs are trading at something like $1.2, $1.3, $1.4 per barrel. And normalized, if you have a new refinery which is supposed to make money, then you should probably be headed towards that $5 GRM sort of a mark. So I think refining is in for a super cycle. Crude oil is in up. Again, once you have this piece of the energy basket move up, there is going to be energy parity. So we'll have the trickle-down effect coming on LNG, CNG, coal, etc. So again, this is one space which is quite undervalued, out of favor. Of course, there is an ESG angle to this whole piece, but once you get a score on this, and if there is some merit in terms of risk and reward, this clearly looks like a good bet.
Okay. Manish, good to have you on the show as always. Wish we had more time.